Welcome here. Let's quickly master forex trading in minutes. I really want to just brief all what forex trading is to us, so that at least we can, if you are new to forex trading and you really don't even know where to start or what it is, so this is a very quick breakdown for you. So it's mastering forex trading, a comprehensive course for all levels. So if you are a total beginner, it will serve as an informative something just to get you involved in some things that are in what forex trading really entails from top to bottom. Quickly, within minutes, we are through. So, mastering forex trading, a comprehensive course for all levels. So, learn essential skills for successful forex trading. Okay. So, the course outline. So, introduction to forex trading, foundational concepts, technical analysis, fundamental analysis, risk management, and trading psychology, advanced trading strategies. So, this course outline just briefly talking about, just introducing to you to forex trading, the foundational concepts. You just need to get yourself acquainted with the technical analysis part of it, the fundamental analysis part of it, and the risk management and trading psychology that you just need to have an advanced trading strategies. But it's just giving you an overview. Is we just want to quickly brush through it, so that at least you have the knowledge somehow. So it's not going to be very long. So introductions to forex trading. What is forex trading? Okay, so forex trading simply stands for foreign exchange. Foreign exchange, exchanging one currency into another currency. And you now coming in as a trader, you just want to be exchanging those currencies for the differences in between, the exchange currency. You need two currencies to really get involved in forex trading and in forex, in foreign exchange. So you now as a trader, we are just doing all these things to keep the difference that we spotted in between those exchanging of currencies. So, and what are the things that we do in forex trading? So currency pairs, we talk about currency. Forex trading primarily involves trading currency pairs. I talked about it. I said it involves two currencies, and it's treated as one in forex trading, which represent the value of one currency against another. So there's no way you're going to value a single currency without referencing it to another currency. So the two reference, I mean the two pairs, I mean the two currencies you are now referring to one another, it becomes a pair. Then you use one which represent the value of one currency against another. Euro USD, for example, yeah, euro, if you are talking about a pair called Euro USD, you are valuing euro based on the value of dollar. So, and invariably, you are still doing the same for dollar too. So, exchange rate fluctuations, and this is where we make money in forex trading. So, the exchange rate fluctuations, the price of those currencies are not always flat. They are fluctuating here and there. And the fluctuation brings about the differences that we really want to capitalize on. So exchange rate fluctuations. So those fluctuations are what really trader aims to profit from fluctuations. Let me pick a pointer. So let's a pointer. So exchange rate fluctuations. Trader aim to profit from fluctuations in exchange rate, which can be influenced by various economic factors, But what concerns us is the profit aspect of it. So from fluctuations, the differences that is being created from these fluctuations is how we make money or lose money. And accessibility to forex trading. Forex trading is accessible to anyone with internet access and trading accounts, enabling participation in global financial markets. What has become so technological to the extent that, can just do this thing. So far, there is internet access wherever you are. So if you have enabling to like your smartphone, you can easily get involved in forex trading. But that you can either, you want to capitalize on the fluctuations in the market. So how the forex market works, it's a 24-hour something operation. Then the forex market operates continuously, allowing traders to buy and sell currency at any time worldwide, at any one time worldwide, because of the differences in daytime and night shift everywhere. As we are in the morning in Nigeria like this, some people might be in another time in, different time zones that we have. made it possible to be 24 hours. So New York session is different from London session, and it's also different from Asian and Frankfurt sessions. And all these sessions outlined, and they are spread out to circle that 24-hour operation, which means, for the weekdays and working days, working hours, you have these 24 hours operations. So 5 days a week, let's say that 5 days a week, because Saturdays and Sundays, except you are dealing with synthetic and what is it called, crypto, but we simply want to deal with forex markets works here. So decentralized markets. So this is another way market forex trading works. Unlike stock markets, the forex market is decentralized, meaning it does not have a central exchange. This thing does not have any central exchange at all. It doesn't have any central exchange. It's a decentralized something. It's not like stocks market. Participants in Forex. So the market consists of banks, financial institutions, individual traders who engage in currency exchange. That's Forex. Generally for Forex. So a lot of people. So major players in the Forex market, you know. There are major players in this Forex. You don't forget we're talking about foreign exchange. We are exchanging currencies of one country into another country. There is purpose of doing that, for business, for tourism, for whatever other something. But as a trader coming in, we are doing this thing for us to kind of like, capitalize on the fluctuations, the differences that is being created with price fluctuations here and there. That's how we either make money or lose money. So the major players in this space is there are central banks. Central banks play a critical role in the forex market by managing the national currencies and influencing monetary policies. The value of every currency is determined by what is going on in that country. But they are sitting above what is going on in that country is the central banks. So central banks governs and do everything. They manage national currencies and influence monetary policies. Monetary policies that are being rolled out by the central banks. So they are the one that is in charge managing it for us. So we have commercial banks. Commercial banks facilitate currency trading and provide liquidity in forex markets, impacting exchange rates significantly. These also commercial banks also play a very major uh, part in foreign exchange. This is just an overview. It's not a complete something. It's just like you want to just master forex trading. You just want to know what it's all about. Watch the video over and over just to have an overview. So hedge funds, this is another major player in the game. So hedge funds participate in forex trading, aiming for profit through speculation. These hedge funds too, they are speculators. These ones, central banks just manage and influence monetary policies and national currencies. Commercial banks, they facilitate currency trading and providing liquidity, They are just they are a major player too. But hedge funds are here for profit too through speculation, often leading to significant market movements. All those big movements, they too, they are part of, they are major players, but they too, they are traders aiming for profit. These people make profit by exchanging currency. These ones are the owner of the currency. So retail traders, where we belong, individual traders, we as an individual trader, hedge funds manage funds they even manage funds for commercial banks sometimes, and bigger companies. So something like that. But retail traders, they are the individual retail traders engage in forex trading for personal profits, unlike hedge funds that is doing it for bigger purpose. And excuse me. So individual retail traders engage in forex trading for personal profits, contributing to the overall market dynamics. We are the smallest part of the something, but at least we are still part of minor major players in the forex market. So that's that. I don't want to keep the video long at all. The attention span of people these days are very, very short, but something like Forex is not something that you can just easily learn with fancy something here and then. It doesn't work that way. Because here you can lose your money. And if you are dealing with something, you can lose your money. And you want to be doing it with ease. Come on. You are still not yet ready. But let's move on. Advantages and risk of Forex trading. So these are the advantages. High liquidity. One of the main advantage of Forex trading is its high liquidity, allowing for quick transaction and price stability. You can just come into the market, do whatever you want to do. You are not dealing, easily do transact wherever you. So these are part of the advantage. Then trading on margin. Forex trading allow trader to use margin, meaning they can control larger position with a relative small amount of capital. So if you are looking for online business, like you can start with a very minor, little capital. Forex trading is one of the something you can get into because of trading on margin. They are allowed to use margin, meaning you can control a larger position. You can come in with leverage, 1 to 100, then you are wherever you bring in, let's assume you bring $100 in, your $100 will be multiplied by 100, and that gives you the advantage of 100,000, I mean, 10,000. No, 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 that's 100,000 with just $100. So, no, that's leverage one with leverage 1 to 100, you have or 10,000 naira at your disposal to use with just $100 based on margin something. And if it is leverage 1 to 1,000, some brokers even offer 1 to 2,000, which means they are borrowing you times 2,000 of wherever money you are bringing in. So, but yeah, there is an advantage to it. There is also disadvantage to it, as you can benefit from so it, so also can you lose from it also. So it comes is a two-edged sword. So margin market volatility in forex markets can be highly volatile, leading to rapid price changes that can result in significant gains and losses. I just told you, two-edged sword. It can benefit you massively and change your life, and at the same time make you lose everything. So potential losses. While there are advantages, forex trading also carries the risk of potential losses, which can exceed initial investment. If care is not taken and you don't properly learn. But if you are getting involved in this space, you must be able to do what? Invest initially in learning, trying to understand what you are really getting yourself into. Don't let money be your initial focus in the market so that you understand how margin works. Because just imagine mentioning leverage, just coming to the market, the broker is offering you 1 to 2,000, 1 to 2,000 leverage, and you can see that they are just after your money. Because how will someone borrow you confidently times 2,000 or wherever you are bringing it? You can use it to your advantage if and only if you are knowledgeable at what you are doing. But if you have zero knowledge, you might not even know what you are doing. You can still make money, but at the same time, if care is not taken, you will lose that money. So you've got to be very, very concerned about potential losses also. So foundational concepts. What are the foundational concepts? Currency pairs and codes. These are we've talked about the introduction and talked about what forex trading entails, all this stuff. But foundational knowledge now is these things are the things, the concepts that you need to just try to say and say how they are. So currency pairs and codes. There's no way you'll be talking about forex trading and you'll not be talking about pairs and codes. So we are dealing with currency. So understanding currency pair in forex trading, currencies are always quoted in pairs. Note that I've said that in the beginning of the video, indicating their relative value against each other. One currency cannot be valued on its own. It has to be in relative to another currency. So also that's what makes us to have peer in this something. So base currency, then how do we, when we're talking about peer and we are linking two something together, I forgot to just include the examples of all those things here. So because I don't really want the video to be very, very long. So base currency and code currency, something like this, where you have Euro USD, then you have Euro USD, Euro, Euro USD. So this is a pair in forex trading. I'm talking about understanding currency pair. In forex trading, currencies are always quoted in pairs. If you come into the something, this is how you're going to say it. Euro versus USD. So this USD you see here is used to value the euro on this side. So then automatically we're talking about base currency. This is now the base currency we are referring to, and the quote currency is the first currency in a pair. This is a pair of currencies now. Then two currencies. If the first currency in a pair is the base currency, we are referring euro as the base currency. And while the second one is the quote currency, showing its value relative to the base. So the value of this one is valued this Euro USD is valued with US dollar. So the price you'll be seeing either 1.111 and all those of that you see, this is the value. You see this 1.111 in on Euro US, then you automatically know that this is the value of Euro in US dollar. And if it is inverted, it might turn to 0. Don't mind my 0.9 something, if it's inverted, then we know that we are valuing USD with euro. So exchange rate calculation, the quote currency indicates how much is needed to purchase 1 unit of the base currency, crucial for trading decisions. The exchange rate calculations, the quote currency, this quote currency, which is US dollar, is indicates how much is needed, how much of USD, how much of dollar we need to purchase the base currency, which is euro. So this price something is indicating how much of US dollar we need in purchasing euro. You understand? So this thing is crucial to trading decision because all the fluctuations that are happening in trading happens based on the fluctuation of all these prices that we have here. So that's that. So another value something concept that you've got to get yourself involved is pips, lots, and leverage. I've talked about leverage in the past. We haven't talked about pips, but here we talked about units. We talk about units somewhere around there. So 1 unit, talking about 1 unit, which means €1, 1 US dollar. And to buy a unit of €1, you need 1.111 USD to buy that based on current something that is available at the moment. So that is that. So moving forward, we talked about pips. We're not talking about pips in the market. What are pips? And lots and leverage. Let's see. Understanding pips. A pips represents the smallest price movement in a currency pair, essential for measuring price changes in trading. If you understand, when I talked about 1.11, let's say 2 1 now. This is the value of this is the value of euro with dollar. You understand? So when we now say understanding pips, a pip represents the smallest price move, the smallest price move in a currency pair, which means essential for measuring price changes in trading. Those two countries, they are almost of the same value, but there is one currency is more valuable than the other. And if we have that, you know, having all these decimal units are called pips. Because we cannot just say, okay, today euro is $2, tomorrow is $3, but it comes in pips. And when you are talking about units, all these ones are units, and in forex trading, we refer to them as pips. So if in last 1 hour, this is the price of euro USD, and in the next hour, we now have something like this, 1131. The price movement, it has changed in 0.0010. So here is giving us 10 pips because it has changed in 10 units. So, and that is pips for us. Unit represents a whole one. And don't forget, this one is somehow tricky, but at the same time, if you get yourself involved in it that much, you will understand it better. So, for better understanding, because I don't want the video to be too long, we can just go type understanding pips in your search bar, then you can easily study that. What are lots? Lots define the size of a trade. In forex, traders choose different lot sizes based on their trading strategies. What are lots? Lot sizes are very, very, very important. You have to understand them. But lots define the size of a trade in what is it called? So what the decision we need to make here is we have standard lots, we have mini lots, we have micro lots. So, forex trading are being traded in lot sizes, in units. You can't just come into the market and say you want to buy one euro USD. So, but they are sold in units, just like you want to buy dozens of something. So also is currency being sold here. So the lowest you can buy is 1,000 units. So you can just buy 1,000 units, then next to it, then you 1,000 units is the lowest, but in multiple of 1,000 units also. Then it gets to that, that's a micro lot. Then we go to mini lot, which is 10,000 units. Then we can now go to standard lot, which is 100,000 units, and so on and so forth. You can do the same with understanding pips, typesetting and something. Then leverage. Okay, I will still make a very long video on all these ones, explain it deeper. If I haven't, I guess I've done that in the past, but it might not be that clear. So we can still, but in the future, we're going to delve deeper into it. So leveraging in trading. Leverage allows traders to control larger position with a smaller amount of capital, amplifying both profit and risk. So this particular something amplifying both profit and risk, I told you is a double-edged sword. And leverage is just simply whatever your leverage is either your broker is borrowing you money, more money. If you see something like this refer to your leverage. And if you are saying 1 to 100, that means your broker is willing to borrow you times hundreds of whatever one you are bringing in. So if you bring 10,000 in, it will multiply it by 100. And whatever it gives to you, then you have that as your capital that you can do what that you can control. You can now be able to control a larger position with your little money you brought in. So these are very important something when it comes to trading. So we have types of orders. Orders too are very, 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 very important when it comes to types of order. We have market order, limit order, stop loss orders, and market orders are executed immediately at the current market price, ensuring a quick entry. We have stop order too. So we have stop loss order, There are a lot of orders in the market. These are just the major ones you have to understand. So market order is when you just enter the market, see what is going on, then you jump into it. You press either buy or sell. And it is an instant execution in the market. Limit order is when you are anticipating, let's assume that the price is trading at this level and you want to enter at this particular level. You can set your limit order here, so that the current price, when the price comes down into the level and you're buying or selling from the place, you can do what? You can continue to move with the market from that limit order you've set for your something. So I have an example of that. Let me try and see. Let me share another something. I guess. Okay. Let me show you one example of limit order here. And okay, so show you an example of limit order. So here is an example of limit order. Market is trading at this particular something. So at this particular level, market is trading at this level. This is my limit order here. I'm anticipating price to come into this particular level before we begin to go up, even though I violated this level, but I didn't believe this level is kind of strong enough to break above and send the price higher into where we are anticipating the price. So also I come down to this level to kind of be anticipating that, okay, market will still come to this level before we go into the highs. So this is my expectation, and this is a limit order in the market. The price is not yet there, and that's what we are talking about when we are talking about limit order in the market. So stop loss order, limit order allow trader to specify a price at which to buy, also ensuring they only trade under favorable conditions. So stop loss orders. So what are stop loss orders? Stop loss orders help limit potential losses by automatically closing the trade when the market reaches a specified something. So this one includes SL and TP. So this one is stop loss and this one is take profit. So they are serving the same purpose, when a price automatically closing either in profit, which is TTP, or closing a trade when the market reaches a specified, like the image I just showed you now. There's a specified level I'm anticipating that, okay, if the price gets from this level, it reverses to this particular level. I'm anticipating higher prices in the market. So if it reaches that certain level, it will help me to take my own profit. And if it goes below where I'm anticipating the market, just take my loss and stop my losses. So that's that about that. So reading forest charts. So you can see many times we just show you charts here and there. Charts here and there. And how do you read them? So price movement analysis. Forest chart visually represents price movement. All those things that you see, all those candles, all those blue and black, it's just see now. Sometimes red and green. You can use any color to represent whatever you want to, whatever, excuse me, or anyhow you would really want to represent your price. So all those price movement analysis, forex charts, we talk about the major something here is charts. So forex charts visually represent price movement, helping traders to identify patterns and trends over time. All those price movement that you see here and there, they are used to do what? To identify patterns and trends over time. Understanding chart types. We have different types of charts. So such as line, we have line, we have bar, and we have candlestick charts. Provide trader with varying insights into market behavior, regardless of whatever you want to use. But bar and candle have the same thing is just the design. They are basically the same thing, except line. The only difference between line and candlestick and bar is just that line doesn't show where price fluctuated to, maybe the high and low that was created during the specific time that you picked. So making informed decision, reading forex charts effectively allow traders to make informed decision based on historical price data. And this is what we are studying. But yeah, I think this is where we need to make a distinction between just trading and becoming a technical analyst. Because there is different, we have different types of analyzing and knowing when to buy and when to sell in the market. And using charts is just implying the fact that you are a technical analyst because you are using charts because fundamental, we still get there, Sha. Let's continue. It helps us, forex charts helps us to make important decision, you know. It helps us to make important decision. Uh, okay, let's move forward. So technical analysis. Let's talk about technical analysis. Introduction to technical analysis. Understanding price trend. Technical analysis focus on identifying price trends which can indicate future market movements and help traders strategize effectively. Technical analysis is just it involves using all these candles, all these apps to do what? To do your analysis, just using system to do all the stuff. So that's the implication of technological aspect of analysis that we talked about. Then using market sentiment evaluation, using market sentiment evaluation. Evaluating market sentiments through technical indicators allow traders to gauge the mood of the market and make informed decision. Just that's technical analysis for you. We use technical analysis is just using what is it called? Using technology to analyze the market, which is using indicator on charts and other stuff. So that's what. Then tools and techniques, various tools and techniques such as moving average support and resistance levels are used in technical analysis. These are just part of something you do on charts to aid trading decision. So as an introduction, support and resistance levels. Understanding support. This is the most vital strategy in the whole of forex trading. A lot of people are now giving us different names here and there and trying to explain to us why that's so. But support and resistance is where you're still going to come back to, regardless of whatever type of strategy you are learning. Because if you're anticipating a price movement up, and at some level you are now expecting that price to return. What happens to that level? It is called a resistance point. So that resistance, whatever tool you use in divining that level does not really matter. At the end of the day, it's serving the same purpose, which is resisting price from going above. The same thing when you are at this level and price get to this level, you are expecting it to react from this level again. What is it doing? It's supporting price. So whatever tool you use, either AMD or ICT, whatever you use in doing that, support the price, Whatever you use does not really matter at the end of the day. It's just a kind of which is a everything comes down to support and resistance. So understanding support levels indicate where demand is strong enough to prevent the price from falling further and attracting buyers. This is just a way of defining what it is. But technically we understand what it is on charts. So understanding resistance levels signifies just the opposite of where supply is strong enough to prevent the price from rising. Something like a ceiling, preventing price from going high. But there are a lot of tools to identify all these support and resistance levels in the market. So, importance in trading. So, identifying support and resistance levels aids traders in making informed decision about entry and exit points. Nothing more to be said other than this statement. It helps us to take higher, very, very good decision in the market. So, chart patterns and indicators. These are part of the things that we do in the market, are part of the things that we do in the market. So, chart patterns and indicator. So, the importance of chart patterns, chart patterns, including head and shoulder, are vital for traders to identify potential market reversal and trend effectively. All these ones are just this lecture notice just to give you an overview. We are not really, really going deep into it, but these are part of the things that we do in forex trading, which is chart patterns and indicator. But most times, when you begin to move to the advanced level of things, you will notice what you will be studying. Not it won't be the chart patterns and indicator any longer. You will be studying what how that those patterns are being formed, then you will not be anticipating or looking for the patterns after they have been formed. Then you'll be able to know when they are forming, how they are forming, and other stuff. But those are just advanced level of things. But key trading indicators, we have so many popular in RSI, MACD, provide traders with insight into market momentum and potential price movement. This is just indicators. But when you get to society level, you see that you don't need. But for at least for now, these are the things that technical analysts use in finding its potential buys or sell in the market just to do what to capitalize on that. So we have using moving averages, trend identification, moving averages help traders smooth out price data, making it easier to identify price trend. These are all the tools. We are just learning about the tools using moving. This is for the beginner traders just to get them familiar with what is going on in the market. But once you become advanced, forex trading application and forex trading moving averages are essential tools for determining optimal entry and exit. But with time, this is just informative knowledge. Don't take it to. So fundamental analysis. What are fundamental analysis? So introduction to fundamental analysis, economic data. These are all the things that make fundamental analysis possible. Economic data, geopolitical events, and intrinsic value. So if you want to do your analysis, we've talked about using all those tools that we discussed previously to do technical analysis. Well, if you now want to use fundamental analysis, these are the tools needed. You need the economic data, geopolitical events, intrinsic value assessment, and other stuff to do other stuff. But we as technical analysts, there's a way we just view our something on 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 charts, and we make our decision based on that. So introduction to fundamental analysis. Economic data such as GDP, employment rates, and inflation can significantly impact currency prices and trading decisions. So there's a way you study all those things if you are a fundamental analyst. So geopolitical events, including elections and conflicts, can lead to volatility in for currency markets and affecting trading strategies. Something like this is happening currently based on the involvement of Israeli and Iran, and in the intervention when US was here to intervene. The market is still balanced somehow, but it's showing some discrepancies here and there. But when US intervene, we now begin to experience some affecting trading strategy and volatility here and there. So intrinsic value assessment, fundamental analysis helps traders determine the intrinsic value of currency guiding their investment decision. This one is very, very important for those doing uh, position trading. Something like this. But as a technical analyst, there's a way we read all these things on charts. So key economic indicators, we have GDP, gross domestic product, is a crucial indicator of country's economic performance and growth. It impacts investment and trading decisions. So if you want to do technical analysis, these are all the tools that you need. Employment figures. Employment figures indicate the health of the labor market and influence consumer spending, impacting the overall economic stability of that particular country. So inflation rates affect purchasing power and cost of living, playing a vital role in monetary policy and investment strategies. Don't forget, this is just an overview and it's deeper than all these things. But these are the key economic indicator that determines the value of the currency against another one. So, all these things are what goes into the fundamental play out of what make prices to do what? To kind of fluctuate here and there in the markets. And this is the reason why we are having some kind of movement in the market. And the impact of news and events, you might have been hearing news is coming out and it's affecting traders here and there. So let's talk about the impact, volatility in forex market. Whenever an important economic news comes out, so fundamental analyst, you know that it creates volatility in the market. News releases and economic events can lead to a significant volatility in forex market, impacting currency value. So the central bank meeting, if central banks would meeting and in meeting are critical events that can influence market sentiment and trader decision, forex trading. These are all the things you have to know as a fundamental analyst. But personally, I have a saying that before you get hold of all this news, market has already done what you want to do, and you might have missed the opportunity of making money. And just analyzing is not enough to do what? Using fundamental alone to make money is not enough to make money in the market, because before you hear the outcome of the news, like the instant that all these things are dropping and are happening is affecting the market already. So the best thing, you can just stay informed. Traders must stay informed about news, economic indicator to effectively react to market changes. And these are the things that you undergo. That was just now the disadvantage of fundamental analysis. But if you find a way of becoming a technical analyst and using all those technical tools to get your informed decision in the market, then I believe you're not going to have that much something in the market. So that's that about that. Let's move forward. So analyzing economic reports, importance of economic reports. Provide valuable insights into market condition, helping traders make informed decisions based on data, interpreting data releases. Traders must learn to interpret the implication of data releases to effectively anticipate market movement. That's for you as a fundamental analysis. If you choose to go by this way, because personally, the essence of being a technical analyst and fundamental or sentimental analysis is simply to identify when to buy and when to sell, so that at least you can make profit from the fluctuations that are happening in the market. So we have different ways of knowing which one is technical analysis, and you just the analysis simply means way of knowing when to buy and when to sell. So your way of knowing might just be technology using charts, all those indicators that we've talked about, those tools, all those technical tools to take your decision, or you want to go by fundamental analysis by finding, understanding all what is going into a currency pair before you take your decisions of buy or sell. Or you pick whatever. So analyzing economic reports, all these things comes with what trading based on fundamental analysis that you do. So adjusting trading strategies, understanding economic report, allow traders to adjust their strategies, optimizing their chances of success in volatile market. That's if fundamental. So risk management, this is your hedge in trading. Risk management and trading psychology. You have no other edge around it. So risk management is very, very important in your trading career. And there is nothing, if you really want to make money and you're serious about making money in this industry, you've got to be very, very big on risk management, because a lot of things are happening these days with the war going on around the world. It will tell on your accounts if care is not taken, because this is the only edge that you have in the market. So identify potential risk. First, effective risk management starts with identify potential risk that could impact your trading outcome. You have to be you must know what you are doing. That's what we are just talking about. Mitigating losses. Mitigation strategies help minimize potential losses and ensuring capital is protected during trading. And that's one style of managing risk. But this is just to give you an overview. Don't forget. Protecting capital risk management is essential for protecting your capital and enhancing the longevity of trading practices. If you don't protect your capital here, you will just run dry as soon as you enter the market, because that's your only hedge. Market is not merciful to the extent of telling you that you don't know what you're doing. Nothing concerns markets with that. It's going to take away your money. So you have to be very, very and double down on risk management. So sustainable trading practices, these are all the things you just have to do what to have in mind. Do what implementing risk management ensures sustainable trading practices, enabling traders to thrive in the long run. Long run is the day. Don't plan to come here to just make a very short term money. Trading is more than that. It's a long term game, and you must be ready and prepared for it. Setting stop loss is very, very important, and take profit. So importance of stop losses. Stop loss order are essential for minimizing potential losses in trading, offering a safety net for traders. If you are wrong, you say your price want to go up and you're anticipating this level, and market reverses on you, and it did eventually come down, and it can continue to go down if care is not taken. So, and you buy here without any stop loss. You don't have any stop loss in the market and you are buying from this particular level, then automatically whatever is in your account can be taken out with this move downward if care is not taken. If care is not taken. But using stop loss just help you to stop the losses immediately market gets to the level. And all this will move price movement below your level will not have effects on your account. So these are the benefits, importance of using stop loss. Benefit of taking profit, take profit orders help secure profit by automatically closing trades at designated profit level, ensuring gains are realized. We've talked about that previously. Risk management strategy, both stop loss and take profit. Others are fundamental risk management strategies that contribute to long-term trading success. Don't just come into the trading world and start taking trades without the idea of where to stop your loss and where to take your profits. These are very, very important in the market. And that's the reason why stop losses and taking profits, they are the most vital after entry. Know your stop loss, know your take profit. This is how you play the game in the long run. So let's put it there. Managing emotions in trading. We're talking about trading psychology here now. Importance of emotional control. Emotional control is essential for trader to make sound decisions and improve trading outcomes. You have to be able to know how to manage your emotions, because if losses get to you, you're going to eventually make mistakes in the long run. And managing fear and greed. These are the two major reasons why many men fail and success. They were successful. Greed sometimes play an important role in pushing you toward greatness in life. So, but at the same time, the two has to be balanced. You must learn to manage fear and greed. You must learn how to manage and balance them, which can lead to impulsive and irrational trading decisions. Making rational decisions by managing emotions, traders can focus on data and logic, leading to better and more info. These are the things that are very, very important to your psychology. And don't forget, your hedge in market is your risk management and psychology. So you must be big on them. This is just an overview. Don't forget. So developing a trading plan, trading strategy must be involved in your trading plan. Because after you've learned, get yourself acquainted with what forex trading is, you learn a way that you want to be doing it, either through technical analysis, fundamental analysis, then you balance your risk management skill and at the same time balance your psychology. The next thing you need to do that will help your success in the long run is developing a trading plan. So a trading plan, trading strategy, your trading plan have to involve your trading strategy, your risk tolerance and goal settings. Your goals, all these things must be indicated in your trading strategies. Trading strategy, a well-defined trading strategy is crucial for making informed trading decision and maximizing potential profits. You must be a well-defined trading strategy. You must know what you're doing. That's what it's telling us. Risk tolerance, understanding your risk tolerance, help you manage your potential losses and make smarter trading choices tailored to your comfort level. You must understand your risk tolerance also. It's very, 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 very important. So goal settings, setting clear trading goals, provide direction and help track progress. Keep you focused on what? On your trading journey. You must know what you are doing. You must know it. That's that. The video is becoming very, very long. So risk management and trading cycle, understanding risk management. Risk management is crucial for successful trading, helping traders mitigate losses and maximize profits. You must know that. Importance of trading psychology. It plays a vital role in decision making, influencing how traders react to market fluctuation. This fluctuation of a thing, this is what makes us money and takes away money from us. So when you're witnessing all those fluctuations in the market and your emotions are not balanced, you make mistakes. Because sometimes before market buys, it will sell. Before it sells, it will buy. And it's doing the two simultaneously. And if care is not taken, if you are flowing and allowing the movement of market, the fluctuation to get to you, then you're going to make a very big error. So preparing for forest challenges, being prepared for the challenges of forest require continuous learning and applying risk management principle. You have to be very, very big on risk management. So advanced trading strategies, what are the advanced ones? So divine definition of scalping, the way I just designed the lecture note is very, very similar. So that's the reason why I have to talk and talk and talk and talk. This is just to give me an overview of what to discuss in the something. So divine definition of scalping. Scalping, these are just trading strategies. So it's time advanced somehow because you have to know what you're doing before you get into it. So definition of scalping. Scalping is a trading strategy focused on making multiple trades to profit from small price changes throughout the day. You're just sitting with your system, making price decisions, flowing with the markets and other stuff, in minutes. Quick decision making. It takes quick decision making. Successful scalping requires trader to make swift, informed decisions to take advantage of fleeting markets opportunities. So precise execution. You have to be very, very precise in your dealing when you are using trading strategy of scalping. So execution must be precise to capitalize on small price movements without significant losses, requiring skill and focus. We've had that. So the trading strategies is another strategy in the markets that you can use engage in the market. So understanding day trading. Day trading involves executing multiple trades within a single day to capitalize on short-term market trend. And currency pair trading, day traders focus on buying and selling various currency pairs to take advantage of market volatility during trading hours. Don't forget, we are here for the fluctuations, the different. So risk management, effective risk management strategies are crucial for day traders to minimize losses and protect their capital. Don't forget that. So swing trading strategies. We are talking about advanced strategies. We've talked about scalping, day trading, and at the same time talking about swing trading now. So swing trading, understanding price swings. Swing trading aims to capitalize on price movement occurring over short periods, typically from a few days to weeks. So, day scalping is just trading within trading hours, day trading just capitalizing and buying the whole day, just it can last for 2 hours, 3 hours and all. But swing trading can last for days, from hours to days, to weeks. Identifying entry points. Traders analyze price patterns. This is just typical swing in the market when we're talking about one price, price move from this level, and at the same time, and yes, have this movement in markets talks about the swing, and that's the reason why price pattern is what is most times referenced as swing. This is swing point in market and trends to determine optimal entry points for their trades, maximizing maximizing potential profit. This is very, very important and crucial when taking trades, mark in which as a swing traders. So exit point. Determining exit point is crucial for swing traders to lock in profits and minimize losses based on, if you want to be a swing trader, you can go ahead, learn more and do that. So position trading. Position trading is just, defining position trading. Position trading focuses on holding trades for an extended period, allowing traders to capitalize on long-term market movement. So fundamental analysis importance. I've talked about this when we are talking about fundamental analysis. And I said all these things are very important to position traders. If you pay closer attention to what I'm saying, here we have it, the fundamental analysis importance is successful position trading relies on thorough fundamental analysis. You don't use much technical analysis. So it's thorough fundamental analysis to identify trends and market conditions. So these are the things that fundamental analysis is very, very important to position traders. So long-term market trends, position traders focus on understanding long-term market trends that can influence their trading decision over time. So you have to pay attention to that if you want to do what you want to be. So conclusion of everything is now we've completed this mini course. Congratulations, you have successfully completed Forex trading course, gaining essential knowledge and skills. If you pay closer attention. And if you watch to this level, I believe you are somehow ready. So understanding Forex trading, you are now have a comprehensive, not that comprehensive, but at least from top to bottom, now have little understanding of it, of both foundational concepts and advanced strategies for trading. You but don't stop. You don't need to stop. This is just an overview. There must be continuous learning. Continue to learn and practice regularly to further enhance your forex trading skills and strategies. So that's that about that. You have to continue to learn. Thank you if you watched to this level, and I believe you've gained one or two. And stay tuned to do it to kind of look forward to my other lectures. It's going to roll in as we begin to roll in. Almost every day I'll be dropping basic knowledge. And I believe it's going to help all of us together. It's helping me to refresh my knowledge in the market and at the same time teaching you valuable knowledge from experience. So that is that about that. Thank you very much. Have a lovely trading ahead. So